regulators can require banks to diversify their lending. You know, you can only have this percentage of your capital in commercial and industrial loans. You can have that percentage of your capital in commercial real estate loans. You can have this percentage of your capital in farm loans. You must diversify your assets. You can't just have all your assets like this. It can also tell banks that, no, you're not in the business of real estate, banker. So all these real estate developments, so a problem that was going on in the financial crisis was all these residential subdivision development projects went defunct in the Carolinas and Florida and Georgia. And so we had what was called pipe farms out there. It's just vast stretches of land where all you can see is pipes sticking out of the ground from these construction projects that started that couldn't finish, right? And so a businessman or a real estate developer would probably sit on that land until the market recovered a little bit and develop it and sell it off at less of a loss or maybe even a profit. In contrast, regulators made bankers sell that because banks are not in the business of developing land. If they acquire these assets through foreclosure, they can't hold on to it. They can't really pay developers to come in and help build this up. If a building is more than like 80% completed, they have the right to finish the completion and then sell it, but otherwise they have to just liquidate the property. So this is an example of an asset restriction that regulators pose on banks. Probably a more practical one is stocks. Banks aren't allowed to hold stocks, except for some banks which were grandfathered into holding stocks of other banks. Because the presumption is that if a bank is qualified to do any sort of fundamental analysis, it's going to be of another bank. A bank can understand another bank's business model. A bank should not be trying to assess a car manufacturer's business model. They should not invest in risky things like stocks. We also have liability side restrictions. And these basically say that, or one example of these is that you must limit your exposure to certain counterparties. That is, sure, you can take loans out from Bank of America's and JP Morgan's, but you can't have more than 10% of your capital in exposure to these financial institutions. Because if these financial institutions fail, then if you have too much of your capital tied up in them, and you owe the money and all that, or they can't owe you that much money. Because if they fail and they owe you a lot of money, you're not going to get it. So that's sort of a liability restriction. So you as a bank can't lend to other banks past a certain threshold, and other banks can't borrow from you past a certain threshold. Another example of this is banks are limited in their access to hot money, as we call it. Hot money are deposits over the insurance threshold and broker deposits. So sometimes when a bank has a positive NPV project coming up and just can't quite acquire the funds to do it, they will call up a deposit broker and say, "Hi, Mr. Broker, can you get me $40 million? And Mr. Broker looks around and finds generally municipalities or the Navy or somebody with extra money and says, yes, Mr. Banker, we found you an extra $40 million. We'll take a 2% cut. Here's the rest of the money. And the problem is, this is what's called hot money, is these people don't have any loyalty to the bank. If that bank starts underperforming, then the Navy or this municipality in Arizona or that one in Florida will take their money out of a bank in Oklahoma. They have no vested interest in keeping the economy in Oklahoma alive. And all of a sudden, the bank has an effective deposit run, a bank run. They lose a lot of funds all at once. So regulators come in and they say, if you're a bank that's not well capitalized, we won't let you have more than X percentage of broker deposits, for instance. Okay? But perhaps the most important restriction that regulators place on banks is capital restrictions. And there is a long tradition of making sure that banks have adequate capital ratios. And I'm not going to give you guys the numbers because there's like 4 or 5 different ratios and they all have different numbers and they're all confusing and take a while to explain, but the concept is regulators step in and say, bank, you are contractually obligated to hold this much in capital, this percentage of your assets in capital. If you hold less than that, we reserve the right to come in, close your bank immediately, and take the keys. Let's say this region, you are critically undercapitalized or severely undercapitalized. Here you are critically undercapitalized. So we probably won't take your keys, but we're already finding a buyer for you, and you won't be around much longer. This region, you're undercapitalized. We're not happy with what you're doing. We're going to put some restrictions on you. Fix it. Get more capital. This region, you're adequately capitalized, and it's okay. It's like getting a B. This region, you're well capitalized. You can get away with murder. As long as you have enough capital in your bank, you can pretty much take any risk you want. That's an overstatement. Don't quote me on that, but you can get away with a lot. Does that make sense? Mm-hmm. So it all comes back to what we were talking about a couple classes ago, is risk versus risk protection. Capital is king. Capital, if you're well protected against your risks, you can take whatever risks you want. Okay. Now, how are these restrictions enforced? They are enforced through regulatory examinations. These are people that come into banks periodically. If you're a risky bank, will come in more frequently. If you're a safe bank, we'll come in every 2 or 3 years. If we're the Federal Reserve and are way overworked, we'll come in every 5 years. And we'll sort of assess how well you're doing. If you have assets that you shouldn't have, we'll make you do something. If you're not recognizing your loan losses quickly enough, we'll make you charge off some of your loans, et cetera, et cetera. So examiners come in and assess the financial condition of banks. They assess how well management is doing, and they assess a host of other things, board of directors and stuff, and so they enforce it. And that's probably the most day-to-day kind of interaction that regulators have with the banking system, is through examinations. And some other notable things that regulators do is we talked about it, they restrict entry into banking. They make sure that it's only competent people that get into banking, which they try to make sure. I should say that's definitely far from the case. And they make sure that it's not, or they try to make sure that it's not fraudsters that'll get into banking. They have restrictions on competition, or at least they had historically. Those are all the branching laws. Another important thing, they got pretty big pretty recently, is consumer protection. Two chairmen of the FDIC ago, I can't remember her name, but I started under her name. She was really, really big in consumer protection. We were slapping UDAPs on banks all the time. UDAPs are unfair and deceptive something practices. And so these are enforcement actions where the regulator says, bank, you've done something wrong, now pay a lot of people a lot of money. And these were very popular because a lot of banks did a lot of stuff wrong. And example of unfair and deceptive practices are maybe not disclosing your credit card fees fully, or keeping it in super fine print where people don't see it, or soliciting offers, or giving robo-lending was a great example of that. Have you guys heard of robo-lending? This is all the major banks got in trouble for it. Had like billions of dollars in settlements where, okay, you meet these requirements, we'll give you a loan for a house. You meet these requirements on paper, we'll give you a loan for a house. We don't verify if you actually meet these requirements. If you tell us you earn $200,000 a year, and you tell us you have $3 billion in assets, you are guaranteed a loan from us. We have no intention of verifying that. And, you know, that sounds like some behind the scenes stuff that takes place at a bank's back office, but in fact, bankers were taking advantage of that. Because if you think about where loan officers' incentives lie, once they make a loan, it's going to take 2 or 3 years for that loan to default. There's a good chance that loan officer will have moved on to another bank by then. But you get bonuses for all the loans you make, for the amount of loans you make, for the dollar amount of loans you make. So your incentive as a loan officer is to try to give as many people loans as you can, provided it won't come back and bite you in the butt too soon. So that was going on. So bankers were selling these loans to people that they couldn't afford, or so the argument goes. There's a lot of people who don't believe that. And so when the regulators were able to document that sufficiently to whatever judiciary party they needed to, these banks got in trouble and got slapped with UDAPs. So this is also stuff that regulators do. Now I'm going to briefly talk about the financial crisis, but not the one that we're thinking of. So basically we left off last class mentioning how the FDIC came about. It came from the banking crisis of the 30s. We talked about FDR and his first act as president, and the statistic is from 1930 to 1934, 33, an average of 2,000 banks per year failed. There's a figure 18.1 in your books that has a nice little graph of bank failures. And so this is a lot of banks to lose over a very short period of time. And so that's why the FDIC was created. They stepped in. There were some other measures taken to avoid bank failure. And so if you fast forward now to the era of 1934 to 80, we averaged about 15 bank failures a year. Much better, right? It's very difficult to prove causality that it's because of the FDIC and it's because of those measures, but we're not even comparing apples to oranges. This was the post-Great Depression period, and we had a couple mini blips here, crisis-wise, but nothing of this magnitude. But this is a much more manageable number of bank failures. 15 a year, an economy can live. The problem is somewhere around here, in the 60s and 70s. We talked about the emergence of the shadow banking industry. Can somebody remind me a few facets of shadow banking? Anyone? Does anyone remember what one element of shadow banking that we talked about that caused banks with deposit rate ceilings to become very uncompetitive? Anyone have it in their notes?
Thinking about a global, facilitating credit across a global financial system.
I do not remember speaking those words. Was that from the book, or did I say something like that? I'm sorry. I was thinking of money market mutual funds. Good try. I don't mean to discourage you from participating. Money market mutual funds. So these were funds that were created to sort of bypass the deposit rate restrictions. Do you guys remember talking about those? See some hands nodding. No? Fabian?
No.
Were you in class last time? I can't remember.
Mentally, I don't know.
Okay, fair enough. I do that all the time. I'd be the last to blame for it. But money market mutual funds were basically a fund that was dreamt up in the 60s or 70s, I think, early 70s, to say, look, we'll let you guys put money in our accounts. We will invest this money in really short-term assets that we can liquidate like this if we have to, and you can even write checks on your account. So this is effectively a checking account, except we can pay you the market rate, or somewhere closer to the market rate. Versus at a bank, you can only get 5%. So deposit rate restrictions. So this is one thing about the shadow banking industry. What else did we talk about? We talked about different parties that were now able to grant loans. Before it was only banks that granted loans. Now car dealerships were granting car loans. Mortgage companies were granting mortgages. Stuff like that. So banks had a harder time competing. And I didn't stress this, the book talked about it, there was financial innovation, which is basically the creation of new fancy kind of financial instruments like...
Yeah, that's what it says in here in reference to shadow banking. It says that financial innovation and the growth of shadow banking, they had to financially engineer types of innovations, responses to supply, responses to demand, and avoidance of regulation.
Yes, yes. So, shadow banking, I would say, is an avoidance of regulation. Sweep accounts are an example of financial innovation that was in avoidance of regulation. But, yeah, that encouraged a little more risk, but that wasn't the sort of bad type of financial innovation. The bad type of financial innovation, let me finish writing the word, were basically derivatives. Swap accounts, and junk bonds. Junk bonds got dreamt up around there, and those weren't derivatives, but they were really risky debt that previously didn't exist, that banks who are allowed to invest in debt could invest in these junk bonds. And so this increased the risk in the financial system. And this was all going on during the 60s and 70s. And then in 1980, we talked about a very dramatic event that happened in 1980, where the deposit rate restrictions were lifted. Deregulation happened. And basically, it was like a free-for-all. It wasn't only the deposit rate deregulation, but banks could now expand into lending that they weren't previously doing. And the most notorious case of this were savings and loans. Savings and loans, S&Ls, also known as thrifts, were these subset of banks that were set up primarily to serve the local community. You didn't do any of the fancy investing stuff. You didn't make these out-of-town loans. All you did was took in deposits, CDs, checking accounts, and made mortgages. You didn't do small business lending. You left that up to the specialists. All you did was took in deposits and gave out mortgages. But with deregulation in the 1980s, these S&Ls, or thrifts, were able to do a whole lot more. And that's good. Generally, options are good. But it took a while for talent to catch up. The current people who were in charge of these institutions were specialists in taking in deposits and giving out mortgages. They were not specialists in small business lending. They made a lot of really bad decisions. On top of that, they now had to compete. Now, instead of their funding costs being fixed at 5%, they had to compete with inflation. Inflation was like 11% around then. They had to jump, their funding costs had to increase to, 10, 11, 12%. Maybe less, I don't know, but more than 5. And that made it harder for them to survive in the long term. And what two of you guys will present, or two groups will present, is about how banks ultimately failed. This was the biggest spike in bank failure, as you can see from this table, or figure 18.1. This was the S&L crisis, 80s to 90s. In 1980, it started catching up, and it just kept going. It spiraled out of control. The FDIC didn't have enough money to support all these failures. They had to go out, they depleted their deposit insurance fund, they had to go out to the Treasury, borrow more money. People were pissed. Regulators messed up. And heads were rolling. The people wanted to blame things on regulatory inaction, and they were justified in doing so. Regulators failed to prevent the worst banking crisis in history since the Great Depression. Not in history, since the Great Depression. So, that introduced fiducia. I know her. Federal Deposit Insurance Corporation Improvement Act. There was a lot of room for improvement. So, this act had to address sort of the short-term, kind of put the fire out before we redo the whole system. And the way it did this was it increased access to Treasury. It made the Fed pitch in and cover some of the losses, because the Fed was regulating some of these banks, and the Fed was making bad loans to some of these banks that actually exacerbated the losses that the Deposit Insurance Fund faced, made them worse. But it also had some lasting changes on the economy. So this is the same act that said it's not fair that we have too big to fail. What's going on here is these big banks get implicit subsidies from the government. No one believes they're going to fail. Everyone's dumping their money into big banks because it's safer, it's more liquid. That's what's causing the small banks to fail. So that officially did away with too big to fail. Whereas before, the Senate admitted that these 11 banks, or the regulators admitted that these 11 banks were too big to fail. This did I hear something?
LIBOR thing?
LIBOR?
11 banks that,
No, that's the London Interbank stuff. That the LIBOR thing busted, I think, 2012, 2013, so a bit later. But this was, yeah, the 11 banks in the United States that earlier today I mentioned that the regulators admitted we will not let these banks fail. We will take dramatic measures to stop these banks from failing, including ensuring a higher share of their deposits than we would for anyone else. So, no more too big to fail. Most importantly, this act introduced prompt corrective action, which in banking circles has all the connotations of the Grim Reaper. This is basically a set of regulations and requirements that say a bank has not enough capital, regulators are going to swoop in and micromanage the bank. So prompt corrective action, or PCA, is an important banking concept. It's basically a set of regulations that give regulators access to manage a bank prior to the bank being basically at the level where they have to fail. Regulators can come in and say, all right, this management team, I want them out. These assets, I want them written off. Okay, they just come in and they mess everything up, they put out a bunch of fires, start a bunch more, and they effectively take over the bank. That's too strong. They have a very strong-handed approach in trying to fix this bank before it hits critical mass. And this is where your bless you, where your capital ratios came from. The first set of capital ratios came from. This was 1991.
Sorry, what was the meaning of TBT?
Too big to fail, I'm sorry. That's actually a good acronym to know, because in finance settings, this acronym is thrown around, TBTF itself, and it applies to I'm pretty sure this confused you. All right. Work. Shortcuts get me not that far.
Sure, the intention though is not completely take over and let the regulators run the bank for, right? It's also to give it back to the people.
Yes,
Give
so
it back to the bankers.
step one is still stopping the bank, coming in through regular examinations and saying, look, bank, we don't like what you're doing, cut it out, get more capital. Step two, if you hit this undercapitalized or critically undercapitalized levels, then PCA kicks in. Then you step in and you say, all right, everyone out of my way, we're going to fix this our way. If you can do that, then you gradually back out of this. All right, private sector take over. I don't want to equate this with nationalization. This is something much, much, much weaker than nationalization. But this expands the FDIC's power to actually take actions to save the bank. The FDIC is not a stakeholder in the bank. They have no vested interest besides the deposit insurance fund to keep this alive. It's not like they own it. But it gives them much more strength to take, concrete measures to prevent failure. Does that make sense? Okay. Yes, the intention is always to give it back, just get a better manager in there if it's the manager's problem. If it's usually the manager's problem, otherwise the FDIC would have no reason to say that. Okay. Table 18.2 puts it in perspective. Some of the costs associated with financial crises. The savings and loan crisis, I think it cost us $200 billion loan from the Treasury, and some other depleting the deposit insurance fund. Probably didn't exceed $200 billion at the time, and some other operating costs. So maybe you're looking at 50, 60 billion max, which with the U.S. GDP, I think was 2% of GDP that it cost us. So I probably know the actual number too, but it wasn't anything insufferable. In contrast, if you look in table 18.2, you have the cost of rescuing banks in various countries, and you see that Indonesia's banking crisis in the late 90s, early 2000s ran them 57% of their GDP. I can't imagine why Indonesia is still around. It sounds like it would still be anarchy, but 57% of your GDP is a lot. Argentina suffered 55% of their GDP in losses due to their banking crisis, and the list goes on. Even Jamaica wasn't immune. 96 to 98, they lost 44% of their GDP. So banking crisis can be costly, which gets us to the Dodd-Frank Reform Act, and an apology on my behalf. As usual, my class did not take as short as I thought. I'll let you out on time, I guess. So, Dodd-Frank Wall Street Reform Act. Usually abbreviated as DFA, Dodd-Frank Act. Had 5 important provisions. Consumer protection. This was a scathing indictment of all these horrible lending practices and unfair and deceptive practices that banks had going on during the financial crisis, including robo-lending and stuff, and they put actual rules in place to try to avoid that going forward. Expanded resolution authority. Resolution authority is the authority to resolve a troubled institution's problems, assist in their resolution. So before, there was a lot of power that regulators had over banks, but not that much power over, let's say, other financial institutions like MetLife, who have, their insurance company, but they have a huge amount of contracts with all sorts of other financial institutions that their failure would screw us over. So one of the biggest arguments against bailing Lehman out, one of the most valid arguments against bailing Lehman Brothers Investment Bank out, is we had no right to do so. In the United States, there was no regulatory authority that lets regulators step in and bail this company out. We had to let them fail. I mean, this is just the way our law works. And so this expanded regulators' authority not only into the pockets of commercial banks, but also into the pockets of investment banks, other financial companies, non-bank financials. It also reminded us that instead of focusing on micro-prudential regulation, that is, instead of going in individual bank, are you okay, bank, are you not okay, bank 2, are you okay, are you not okay, we need to consider what's going on in the entire economy. This, in my opinion, was the first major step the United States has taken to understand that it doesn't matter if Bank A or Bank B fails. It matters if all of them fail together. And so, write this down. Macro regulation. And this is the part of the act that sort of established SIFIs, systemically important financial institutions. By the way, if you guys haven't realized by now, the world of banking is full of acronyms. So there's currently, I think, 31 of these guys. That I think one of the thresholds is they have to be over $50 billion in assets. There's other thresholds that would qualify you even if you're not over $50 billion in assets. And you are subject to a host of other regulations. Instead of having periodic examinations, if you're a SIFI, there's a regulator on site not 24 hours a day, but every day of the year, trying to make sure you don't screw up, and you have to run decisions by him or her. And you're also subject, very importantly, to higher stress testing. So there's stress testing that came out of Basel III, which we won't talk about, and there's Dodd-Frank Wall Street Reform Act stress testing as well, that you have to make sure it's also known as a living will. You have to make sure that if something goes under, if interest rate spikes, if you have deposit outflows, you have to have an action plan and a backup plan and a backup plan for how you'll be able to address these kind of things. It's really an error on the side of caution perspective now. All banks are subject to stress testing. These guys are subject to really intense stress testing. Importantly, you also have the Volcker Rule. And Crystal, I read your extra credit assignment. You went extra credit and talked about Paul Volcker. So maybe, could you give us a summary of who he was?
Mm-mm.
It's boring if I talk the whole time. Anyone else know who Paul Volcker is?
The federal regulator, wasn't he?
He was chairman of the Federal Reserve before Greenspan.
Yeah, he had a big influence on taking on the big banks.
Did he?
As far as when it was during the
It's probably during the S&L crisis. Yeah, because when you get frustrated in your mind.
He was described as a big guy. As far as when he
Yeah. Oh, tall physically? Interesting. He's very influential. I mean, I think he sat on Congress and he chaired this act. He's been pushing for it for a long time, but it got clumped into the DFA here. And it basically says that, all right, banks, we understand you have to trade securities to keep your liquidity stuff going, so you have asset side liquidity, but we're going to put severe restrictions on what kind of derivatives you can trade. So a lot of derivatives went out the door with the Volcker Rule. And sort of went to the step of undoing some of the damage that Graham Leach blithely did in allowing banks a lot of latitude in what they can do. This sort of tried to call some of that in. All right, we'll start prohibiting you from doing stuff that's like credit default swaps, which a lot of banks ate a lot of losses on. And the last thing I'll talk about before wishing you a good night is standardized derivatives trading.
What it says the Volcker Rule limits proprietary trading. What does that mean? And then also on the Dodd-Bill Act, it says was expanded the ability to seize unwind failing banks to those financial institutions deemed system. That one. I don't know how to say it. What does that mean? What is system?
Systemically important? Well, all right, the financial system.
What's systemic mean? I don't.
Systemic means the financial system. So
Okay.
Institutions that are important to the financial system, not just to their depositors, not just to their stockholders, not just to their consumers, to the whole financial system. The Bank of America's, the JP Morgan's. We got to make sure that they're not screwing up. We should be focusing more of our
So
resources.
basically,
to
the
them.
bigger banks.
Yes, that's all.
Systemic means bigger
Systemic.
banks.
Systemically, it just means systemically important means important to the system.
Oh, okay.
Standardized derivatives trading. Yeah, so it just basically said, all right, look, if you guys have to trade derivatives, why don't you trade them over exchanges where they have rules, and it's going to be a lot safer, and there's a lot of, what's the word I'm looking for? If you screw up, if you're a bad counterparty and you default, you're going to have a lot more penalties associated with that. That's one of the benefits of derivatives of exchanges is you see your counterparty face to face instead of just having a broker deal with some counterparty somewhere. So it banned some derivatives trading. It created margin requirements on derivatives trading, and it made derivatives trade over exchanges. And some derivatives, this is also probably important, had higher capital ratios, higher capital costs. Really quickly, what this means is for every asset you hold, every type of asset you hold, you have to have a different amount of capital. So if you're holding a residential mortgage, those are generally safe investments. So regulators say that, okay, for every dollar of residential mortgages you have, try to hold 20 cents, right? In contrast, for every dollar of T-bill that you hold, you don't have to hold any capital. That's not going to fail. But for every dollar of derivatives that you hold, of certain kind of derivatives, they might actually require you to have $4 of capital, just because these instruments are so unsafe that it might actually cost you more than you book it for, because there's a lot of off-balance sheet liabilities associated with this. So I apologize for taking 5 more minutes of your time. I'll give you 5 minutes back next time. We voted that we'll take a day off of bonds if we have to. I'll try to come up with a good lesson plan for the financial crisis. We may be able to do it all.
Can you tell me what the answer to the quiz question number 1 was?
Yeah, asset risk. Asset risk is the most important risk a bank faces. If you said management, I would probably accept that.
Sensitivity to market.
Hey, Taylor.
Sensitivity to market risk. We spent a lot of time talking about it because it's really interesting.
That's why I thought it was.
Because it helps you understand how finance works. It ties it all together. It shows you how banks. Are you all right, Jackson? Yeah. Okay, I thought you would. Oh, okay. Yes, but asset risk. A bank's basic business is to give out loans.